right. Hey, Facebook. Here we go. Mitch is kind enough to join us every month to give us what's going on in real estate from a mortgage perspective. Right. There's a couple of relationships in our industry that very much are tied together. And I don't know that there's many bigger than mortgage and title, which is why we've got Brenna joining us every month and Mitch from a mortgage perspective joining us. The impacts that the mortgage industry is seeing and what's happening there within real estate. So Mitch, working from home on a snowy day, right? No
Yes,
snow day for you. You still gotta put in the hours.
putting in the hours, but I'm a little more efficient hours by not having to be on the road today.
Yeah, you
So,
don't have to hit the
you know,
brakes and avoid the cars stopping in
splashback,
front of you. Yeah,
exactly. And it's more efficient. Save a couple hours of being out on the road. So
yeah.
respond to emails quicker, phone calls quicker, and get to do this today.
Well, you're better than I am because I've tried working from home and it turns out I'm pretty useless working from home. I
Hmm.
joke with Brenna that I would be a terrible stay-at-home husband, father. Like she'd come home from work, the house would be a mess. I wouldn't know where the kids were, and I'd be asking her what's for dinner.
But I understand. Having three children myself, I get that.
Yeah.
So
Um,
totally understand.
Mitch, talk to us about kind of your background real quick and your company with Pivot, who you are, and why we're having the conversation.
Yeah, I appreciate it. Well, we're having a conversation because you and I go back a couple years and working together and knowing each other and learning to work well together and respecting each other's business professionally, and then just as two people working together and getting to know each other as friends. And I appreciate you inviting me on the program. In reference to business, I work with Pivot Lending Group, and we are a mortgage banker here in Littleton, Colorado. So we are truly a local company, and we are a direct lender. And what that means is we handle the loan transactions from the very beginning stages of interviews with our buyer clients to make sure they qualify, all the way through the day of closing and the funding of the loan, and the file never leaves our company or our offices, as opposed to what a mortgage broker could do, which is they send those files out to a different company after all the paperwork's put together, and then that gets approved and funded and closed with a different company. And so we streamline it.
Yeah, which really creates a lot of advantages for working with a company like Pivot and with Mitch, right? Because there's control within the system and some influence, right? Some ability to kind of look outside the box to say,
Correct.
hey, this doesn't fit in this box. It makes sense. Where a mortgage broker may just have to say, hey, I don't have an investor who's going to pick up that loan. Sorry, we can't do it.
Right. And the fact that we have a team that I always work with, as far as my underwriter, my processor, my funder, we all work very cohesively together to make sure we get the job done and on time. Or if we're going to have a hiccup, we know why and we know about it well in advance of the actual closing date, which is very important from a communication standpoint.
Yeah,
So,
without a doubt. So a lot of advantages there,
right.
and questions to ask of Mitch and right or whoever's originating your mortgage loan. But if you're watching this, it should be Mitch. So Mitch has again always been one of my favorite lenders to work with.
Couldn't agree with you more, Matt. Um, and then this is my 33rd year of helping people with home loans and buy homes, whether they're first homes, investment properties, third homes, grandparents, grandchildren. I mean, I've seen people grow up and I've seen them have families and buy and sell. And it's been a great journey along the way to see everybody advance in their real estate side of their investing and their ultimate net worth, which is
Yeah.
what you and I talk about quite a bit, of helping people get there. And we've had some unusual times with the market and interest rates popping up a little bit this last 30 days roughly. Still extremely favorable on the mortgage rates, but not as favorable as they were in the middle of the pandemic, when rates were in the mid twos, and now we're in the mid threes. So still wonderful.
Still better than my first mortgage, which was still low at 6% back in 2008. I think when I bought my first place.
Got it.
Yeah, so pretty favorable there when we look at historical averages and what that
Right.
looks like. So,
Yeah.
Mitch, I'm hearing on social media, and I'm hearing from some folks, how are my kids ever going to afford to buy a house in this market, or how am I ever going to afford to buy a house in this market when the average price has just gone up so much?
Mhm.
How's it ever going to be possible? So, one, the interest rates matter because they're low. That helps impact affordability. And one, I don't want to call it a mistake because I'm not going to judge people on the decisions that they make for their life. But one area that I see people avoid kind of looking is, well, I want to buy my ideal house first, or I'm just not going to buy a house. And gosh, we can ride the wave of appreciation and get our foot in the game by getting into a condo first or a townhome. And we're going to talk specifically about condos at a much lower price point. I can get into this real estate game, let the market appreciation go, the forced debt pay down, the tax benefits that you have, and gosh, sometimes those condos make great rental properties after you move out. Um, so tell me from your perspective as a mortgage loan originator, why should somebody look at buying a condo?
Well, there's a lot of advantages, and then there's a lot of caveats to understand what you're buying. So the advantages of buying a condominium are typically they're less expensive to start with out the gate, which means monthly payments are lower. Money or funds out of pocket for down payment are reduced because it's a lower price. And then there is the ease of owning a condominium because you don't really have any maintenance on the exterior typically of a building. So if you want to go away for a week or a weekend, or just don't have the time, or you're not interested in doing extra yard work or painting your home or of all the upkeep on the exterior, you have what are called monthly homeowners association dues that get paid for each month, but they take care of all of those items. So it's a very turnkey alternative to having to be a homeowner and taking care of your home at a much lower cost. And to your point, getting in the game of buying real estate versus not, and be staying a renter till you can afford to buy that house. I hate to say it, but as we always talk about it, you kind of go backwards if you don't get in, because trying to keep up with the inflation, well, not with the inflation, but the appreciation of a home, and try to save to the same level of a $400,000 or $500,000 home appreciating, it's very difficult to keep up with that from a cash saving standpoint. So condos are great alternatives.
Yeah, I always said that I was a consumer. And back when the market crashed in 2008, I was in a different industry. But, I joked, I said, here's how I'm supporting the economy, right? I'm going out, I'm spending money. I wasn't nearly in the mindset of saving money. So saving up to try to save up for that dream house when the across the nation, as Brent and I talked about yesterday, we saw 18% appreciation in the housing
Right,
market.
right.
Uh, on a $300,000 house, gosh, we're looking at almost 60 grand in savings. That's that might be easier for some, I guess, than others. It depends on how much money you make and how great you are at saving. But gosh, you could take it and again ride that wave of appreciation. So
Right. And you could buy a condominium at that price, but you can't buy a home for $300,000 anymore.
yeah, yeah,
So,
I heard this joke years ago, and it was related to a school that was predominantly one gender over another. And I asked the person, I said, well, how is it that it's got to be good for you, right? Being the opposite gender. She said, well, it's kind of like a parking lot, right? The guys are either handicap taken or they're way out there. And I kind of feel like that is what we see with the housing market to some degree. Either the house needs a whole bunch of work, it's already under contract, or it might not be in an area that you want to be. When it comes to detached homes, right? So a
correct.
$300,000 detached home might be far out there, or it's going to need a lot of work.
Right.
The condo, you can walk into a really nice condo, for that number and have something that's worth living in.
Right. And again, it pays to get into the market as opposed to sitting on the sideline and start building appreciation. Because what's happened is many people are in the same position of, I don't know that I can afford or want to afford to buy a $500,000 entry level home, but I do want to buy something else, and this would be a great alternative. The reality is there's many people like that. So even if you want to buy a condo and you get in, there's still such great demand for a condo. So if you want to get out 2 years later, there's going to be a strong market still for that, because it's always going to be in the first time home buyer level of comfort as far as buying their first home, just like it is today. So they've just become much more popular because, again, price increases with single family homes, and that will stay that way for a while.
What if I want to be mobile, right? I want to travel a lot, which is kind of my generation and the generation coming up behind me, right? Well, gosh, how easy is that to travel when I've got a condo and I don't have to worry about, hey, do I need to winterize the pipes there for my sprinkler
Right.
system? What's going to happen with maintenance ABC?
Right.
It's a little bit easier to lock that door in a condo and go away for a week or two or whatever that looks like.
Right. And many condos have different ways they're built too. Sometimes they look and feel like a townhome.
Hmm.
So they have townhome style condominiums. So those are very, very actually sought after, but they are considered condominiums. So they live like nobody's above or below you, like a townhome would be, but you might have neighbors. You can find condominiums where you're on the top level, so it feels a little bit more separated from other people. So there's different pieces to condominium projects. They all feel and look differently. And a lot of people are buying them and actually turning them around and flipping them right now. So you could actually find one that's completely redone that looked beautiful and then becomes a true turnkey solution. You don't have to go and buy a new dishwasher or anything like that. It's all there for you.
Yeah, what a great opportunity for a flip, right? Because you don't have to worry about foundation, roof, and
Yep.
sometimes not even a furnace system or a cooling system, depending on what it is that you got. You get to do the fun stuff, right? I got to come in, put new paint, new flooring, new appliances,
Yep.
and we're good to go. So, but you touched on something that was going to be my question to you. I get this a lot when I'm talking to potential buyers, and they say, "Hey, I don't want to buy a condo." I say, okay, tell me what you mean by you don't want to buy a condo. You don't want to buy an apartment style, right? Where you're stacked on top of each other. And they're like, no, 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 we want a row home. But there are row home condos, right, that live more like townhomes. So
Correct.
for those that are watching, share what the difference is here between a condo and a townhome.
Sure. And they're big differences for sure. So it's a really valid, good question. So condominiums were built, and many of them were built back in the 70s, 80s, and 90s. And so there's a lot of older condominium units out there that just made sense to build them that way at that time. And from a builder's perspective, the cost to build and the cost of what are real estate taxes were a lot less expensive when you built the communities as condominiums to start with. And what that meant is each building was its own legal entity with many different units within the building. If they built separate and independent townhomes, each townhome is like a single family residence in the eyes of the county tax assessor and of the new owner of those units. So they would be taxed independently of each other. And so if you had a 50 unit townhome project, that would be a lot of expense, not only for the builder, for them, what they would have to charge a new buyer to come in. So condominiums became a very interesting way of being able to put properties together for builders that were more economical for them. When you buy a condominium, you're buying a percentage of ownership in the entire community as a new homeowner. So if there are 50 units and you bought one, you would be 1/50th owner of the entire complex. And you would see that in the legal description. You own 1/50th of, and then all the boundaries, et cetera, of the condo complex. And so when you own a townhome, if you were to take the walls of the townhome and the interior of the unit and slice it all the way down to the dirt, you own that portion of the ground, just like if you owned your own house. So you own it, the legal description is a lot and block. So you own a certain lot number and a block number, then you own some land. You actually own the dirt below there. And so you own it differently. And then that becomes usually well, not always, but sometimes more desirable because you don't have people above or below you. It's not stacked sometimes like a condominium. And so because they're more desirable, in some cases, they're a little more expensive as well. So condominiums have their place. It's just a different way of owning it. It doesn't change anything in any negative way. It's just the way they were put together legally.
Yeah.
So
the down payment requirements, right? As we're kind of talking about some entry level price points, what are the down payment requirements for a condo? Are they different? Are they the same? What does that look like? And how do the rates also fluctuate?
Sure. And that's a really valid question because a lot of people still think today, even if they're buying a home, that they need 20% for down payment. You and I have had many conversations on our interviews about down payments, what you need, what's the requirement. So for a traditional loan on a condominium, the minimum down payment would be 3% down, and that would be for a conventional loan, better known as Fannie Mae loans or Freddie Mac loans. Or if somebody wanted to utilize an FHA loan, then the minimum down payment is 3.5% down. And if somebody was a veteran, they could buy a condominium with no down at all because they follow the same criteria as any other kind of property. So a condo doesn't change the down payment requirement if it's going to be your primary residence. What their impact is that Fannie Mae on conventional loans charges a little bit higher interest rate on a condominium than they do on a townhome or a single family residence. And the reason they do that is they feel there's greater risk in the fact that if they have to either foreclose on a condominium or if the condominium association goes defunct and they go bankrupt. I haven't heard anything about those in years. 30 years of doing this, I've never heard it once. But that's the fear. If they do, then they no longer have a legal unit that they can sell because there's no association to run it. So now they have an unsaleable property that Fannie Mae has to keep on their books until that association gets back on their feet. So that's a greater risk. So they charge a little bit higher interest rate to the tune of 0.1% in the interest rate higher, maybe 0.25%. So it's not significant, but it's something that people should know about.
Well, it sounds like we should get the lenders to forget about the possibility of it just dissolving completely and just drop that interest rate a little bit. I don't know what petition we need to start, but Mitch, I'll sign it.
Well, you'd be surprised. There are some communities that they're not going defunct, but the health of their association financials is not as good as it should be. And some of them don't meet the current standards for the state of Colorado. Actually.
We'll charge higher percentage to them, and we'll just charge you
exactly
on that one. You want to buy this one where the homeowners association, the association's not financially healthy, we're going to charge you more money for it.
There you go. Exactly. Well, risk and reward, right?
Yeah.
But you bring up a good point. And the beauty of the mortgage banker in this situation is we come in and do that analysis on the condominium project on behalf of really the borrower, even though it's for us, because a typical buyer is not going to know how to interpret all the information because there's so much of it and it's fairly complex, but we do. And we make sure if it meets our needs being Fannie Mae or FHA or VA, then the buyer could feel fairly confident that they're buying into a healthy financial association that will continue in a good light going forward. So it's really important.
Yeah, it's, and even somebody that's in the industry, I don't know that I would look at it and be able to tell you, hey, this is really healthy or really not, unless there's something glaring, right? So great resource to have there on behalf of your folks. So there's, you said gathering some information that's done by way of what's called a condo questionnaire, right?
Mm-hmm.
So tell me about that questionnaire. What is it? And, what are the options around the questionnaire? There's a standard one, and then there's a limited review.
Correct. So Fannie Mae's put together, and then they just recently revised it. But the initial one was there are 76 questions that get asked, and then not all of them have to be answered because some of them are for a brand new community if it was a brand new condo complex. Some of them if there's commercial property within the condo complex or not. So some are just not applicable. That's why there's so many questions. But this condo questionnaire form will go through asking a lot of questions that are very important to understand from again, either the financial health of the community or making sure they have proper insurance for the property in case the complex should catch fire and burn down. They have to have insurance to rebuild that property. Each individual homeowner doesn't carry insurance to build the unit. They have insurance to replace the valuables within their unit, but they're not rebuilding the building they're in. That's where it's called the master insurance policy comes into play. We make sure and determine how many people are renters versus owners that live in the community. They'll look at things like how many people are in default and are behind on their association payments, how many different people own, how many units in the complex. So if let's say there were 50 units and one owner owned 20 of those 50 units, that percentage is very big. And why that's a concern for Fannie Mae is if that one owner goes into default on all 20 units, you now have a community that it's going to be very difficult to get out of and resell it. So Fannie Mae has limitations on how many units one owner can own at one time. All that is disclosed on this condo questionnaire form. That would be what's called a full condo questionnaire form, these 76 questions. In addition to that, Fannie Mae just added an addendum that talks about any kind of maintenance or deficiencies in the community due to the unfortunate circumstances in Florida when that condominium building and community collapsed. And that was just due to deferred maintenance and it wasn't addressed. So now there's another list of questions that the association has to answer about deferred maintenance and if there's any safety or health related concerns within the community. And if there are, and this is brand new, it just happened in January. If there are, we have to get more information to find out what they are and are they truly health and safety concerns or are they just considered deferred maintenance and somewhere down the line they do need to be replaced at some point, like a deck or a roof or I don't know, a fence by a pool or what have you. It could be a variety of different things. But that's going to cause some extra concern and extra work in either buying or selling a condominium because there's going to be deferred maintenance. It just never got asked before. And so we have to address that.
Yeah, I think a great example of real estate, a lot of the things that impact real estate from a mortgage level in particular, but also here in the local, Colorado and then Denver metro, these impacts happen because of things that happen outside of our area, right? Florida is a completely different state, different builder. I don't know if that architect and the builder ever built in Colorado, right? But their negligence leading to some things here that overall, from what I know, now again, you just said this just took place in January, I think will probably have a positive impact overall for a lot of homeowners when it comes to, getting into a property that doesn't have the deferred maintenance, because the lender doesn't want to be holding the note if the building falls down.
Yeah, and really what they don't want to do is be holding the note or the property if they foreclose on it with a property that is less saleable because of the deferred maintenance.
Yeah.
And buyers say, I don't want to go to that community because too much work's going to be done and who's going to pay for it? And who ultimately pays for it is all the owners of the units with something called a special assessment, which is extra fees that are charged to individual owners of the community. You did ask, and we touched on, but I want to get to it because it's really important. The other condo questionnaire form called the limited questionnaire form or limited review. And the reason why that's important is because it is a limited, so it's a lot less questions asked about the community. It does make it a little bit more simplified as far as a buyer getting into the property. And the way we usually get a limited review request is if a buyer puts a minimum of 10% down on a conventional loan. FHA and VA don't have these condo questionnaire forms. There's a different review and analysis that those entities require the condominium to go through. So everything we're talking about is for a conventional loan. And the limited review doesn't ask for things like, let's get a copy of the budget, how many people live in the units that are owner occupants versus renters. They do ask about litigation in the community, which is very important. If there's any lawsuits going on with the association, like if the builder built it and there was something that was deficient, they're working with. So there's a variety of reasons where there could be litigation. So this limited review just simplifies and condenses down the data that we need to get to be able to help the buyer close and purchase a condominium. Still has to be in good health and good shape. It just isn't as detailed as a questionnaire. We use that a lot on investment purchases. So when a buyer wants to buy a condominium for a rental property, there's a little bit more leeway there, and it makes it a little bit more simplified for that investor buyer to buy within a condo complex.
Yeah.
So
the investor brings up a good conversation, right? As we look at, sometimes investors are going to be restricted in buying into a complex or a potential homeowner based on the percentage of investors.
Right. In certain circumstances, if a community has too many renters in the community, that could affect the ability to get a Fannie, again, if this is all Fannie Mae loans or Freddie Mac conventional loans, that could limit the ability for another investor to go in and create another rental property within the community. And there's really two forms that could cause that. One is Fannie Mae's guidelines that says there must be at least 51% owner occupants who live in the community before they'll let you take on another rental, unless you get the limited review that we talked about a moment ago. That negates that guideline. So that limited review does play into that particular scenario to the betterment of the investor. So that's important to make sure we get that limited review to help if we know that owner occupancy could be higher than is, excuse me, the non-owner occupancy could be higher than it's required. So
some things that impact that for sure. Now, the other piece that may impact that is the homeowners association itself, right? They may have in their restrictions and bylaws a certain percentage, because on the mortgage side of it, that's going to impact kind of who's purchasing it. But if I already own one, can I convert that to a rental? And that's where the associations, the rules and restrictions may impact that and something to review.
That's correct. And it's important, of course, to find that out in advance, as well as someone who is buying it, who says, hey, I'm going to turn around and try and Airbnb this property somewhere down the line, which is very common right now. It's important to know that up front before you make that purchase, because it could cause you not to be able to do that. So then at that point, you maybe look at a townhome instead, because there are a little bit different guidelines with townhomes as far as that. Typically, it's a little bit more flexibility because it's owned more like a home versus a community like a condominium.
Yeah.
And then you have your 55 and older communities that they have another different layer other than having to be 55. That's one requirement. But they have different layers of requirements as well that are important to establish before you make offers on them.
Yeah, the 55 plus community is interesting, and I think as a not quite 40, right? I'm 37. Had an image in my head of what a 55 plus community would be, and then my mom goes and moves to Phoenix into a 55 plus community, and I'm hearing about all the amenities and all the cool stuff she's got in her community. I'm like, who can hook me up with a fake ID so I can be 55 and go hang out
18 years
and do all this cool stuff?
Well, they make it a wonderful environment, which is really nice that happens, because why not? I mean, it's like a little resort, actually.
Yeah. It's
which
like
is
living
great.
at a resort, right? You got all this cool stuff to do.
Yeah. It's nice.
Be social and have friends and do all those cool things. So
exactly.
Now I want to pivot here. Now we didn't prep for this, but Brent and I talked about it yesterday when we did our live interview. The Airbnb, right? Very popular. Now, something has come down the pike from the government as it relates to buying second homes. Now this is what was happening, is people were buying a second home, right? It's a second home for me. I'm going to go live in it, and immediately turning that into a short-term rental.
Right.
which is not really the guideline
Right.
for the second home qualification. That makes it more of an investment property. However, what's just come down the pike? What's happening for second home mortgages?
Sure. And it's a good question for sure. So one, to your point, yes, if they're buying it as a second home is truly a home that you're intending to live in for typically half the year and live somewhere else the other half the year. And in doing so, you're able to put a smaller down payment than if it was a investment purchase. And that down payment is 10% currently of the purchase price. And it must be a conventional, and you can't do FHA or VA with second homes. However, to your point, it's been unfortunately used in different fashion than it was intended to. And so what Fannie Mae is doing is they're adding an additional premium or cost to second home transactions where the either cost to keep the same interest rate is going to be very expensive. Those are called discount points. That means you pay money today in cash on the day of closing to help reduce your mortgage rate for the life of the loan. And my understanding is it's going to go up anywhere between 2 and 4 points for that, which means either people pay 2, 3, or 4% of their loan amount in extra cash at closing, or the lender in our industry were allowed to raise the mortgage rate to help cover those points. So instead of getting a 3.5% rate, that rate might be 4.5%. And that is exactly what's happening. And it really is supposed to kick in February 1. So it's quicker than people think. And it's because there's mortgage lingo here, but the short version is when we give this loan to Fannie Mae down the line, it has to already be built in come April 1st. And so it takes lenders about 2 months to get a file ready to go to Fannie Mae. So if we close in February, March, April, it's delivered to Fannie Mae, they're charging it right then and there. So it's kicking in right away. And we actually might even see this on investment purchases as well. And another layer that we already have, an additional one. So we have to be cautious of that and look at those numbers. And what will probably end up happening is people end up paying a little bit more for closing costs in order to use those programs, because they're not going away. They're just being charged a premium to utilize them. Yeah. So really good point to bring up again today.
Yeah, and that was great because I knew the April 1st. I had heard that date. I just didn't understand the nuances and understanding why it's likely taking place starting February 1st. So for anybody watching that's thinking about a second home, let's jump on it here in the next 6 days.
At least be under contract and lock in the interest rate.
We got to get it under contract. We got to move fast, right? So my phone might start blowing up here with people that are watching the video saying, "Hey, Matt, you got to get me into it in the next 6 days." So, I appreciate you sharing that, right? Because we didn't talk about that. It's just kind of where the conversation went. So I threw you out there without a safety net.
I can. Our days are full of that, Matt. we have questions asked of us all day in what we didn't prepare for.
Yeah.
Which is our value add to people is that we are kind of the walking encyclopedia of different parts of real estate.
Yeah, without a doubt. So going to throw another question out here. No safety net, but don't worry, it's not industry type related as we wrap this up. Yep. We finished now 2021 and we're into 2022. For Mitch Friedman, what are you most excited about, either personally, professionally, whatever, about 2022?
Well, I think my first thought that came to mind would be hoping we get through the COVID era in better shape this year than last year and the year previous. I think we've all kind of adapted as well as we could have, and now we kind of know our new rules of engagement, so to speak, within the society, and so we can navigate a lot better going forward. So I think that's hopefully going to be more second nature for everyone. And then from there, I want to play more tennis. That's my goal this year. And unfortunately, my tennis courts are going to be all torn down, we think, here in Boulder, because the place where we play, they sold, I don't know if you know that, the Millennium Hotel, if you ever heard of it. Okay. There's a very large property right by the campus at CU Boulder. and they're going to put student housing there, and they're going to tear out, we feel, all 15 tennis courts, and now we have nowhere to play. So there's my other dilemma.
Well, I'll put you in contact with my father-in-law, who's a big tennis player, loves playing all over, and maybe we'll bring you on over to the tennis bubble at the ranch and let you play there with us for a little bit.
I have played there before. It's a great facility.
Yeah, very cool.
Yeah, that's nice.
So,
Thank you.
Mitch, again, thank you so much for this, and looking forward to our next conversation about mortgages and real estate. There's always so much value added here for this, and I can't thank you enough.
My pleasure. Thank you for the invite again, as usual, and always good to reconnect around real estate. And if anybody who's listening has questions, we're here to help in any way we can. And it may not even pertain to what we just spoke about, but it has to do with real estate.
Yeah, Mitch, I've got your email scrolling there on the bottom line
that.
ticker. So,
thank you.
For folks that need to get a hold of Mitch, you can always reach out to me, but you can connect with Mitch directly there with his email. So,
great.
All right. So excited. Thanks again. And we'll see you guys next time.
Thank you. Thanks, Matt.